Saturday, April 25th, 2026. Markets are closed. Silver closed the week at 75.59. And right now in Islamabad, Pakistan, the next 36 hours are being written in real time by three people whose names most silver investors cannot even spell correctly. Iranian Foreign Minister Abbas Araghchi, White House envoy Steve Witkoff, and senior advisor Jared Kushner. Whatever happens in those rooms between now and Sunday night is going to determine whether Monday's silver open is the most explosive gap up of 2026 or the most violent flash crash since the war began. And I am going to give you the complete setup right now, every data point, every scenario, every trigger, so that when you wake up Monday morning, you're not scrambling to understand what happened. You already know, you already have your plan, and you're positioned while everyone else is still reading headlines. Let me start with the most important thing happening right now that is not being reported correctly in any mainstream financial outlet. Araghchi arrived at Noor Khan Air Base in Rawalpindi Friday night. He was received personally by Pakistani Foreign Minister Ishaq Dar and Field Marshal Asim Munir. 9 U.S. aircraft have already landed in Islamabad, carrying communications equipment, vehicles, security personnel, and technical staff. Witkoff and Kushner are flying to Pakistan this Saturday morning. A Pakistani government official told Al Jazeera there is a high likelihood of a breakthrough. That is the optimistic version of the story. Here is the version that matters for your silver position. Iranian state media outlet IRNA explicitly framed Araghchi's trip as a bilateral visit to Pakistani officials, not a meeting with American representatives. Araghchi himself posted on X that his purpose was to coordinate with partners on bilateral matters and consult on regional developments. He made zero mention of Washington in that post. The Iranian government's public communication and the Pakistani government's optimistic briefing are telling two completely different stories about the same set of meetings. One side says breakthrough is likely. The other side says this is not even a direct U.S.-Iran engagement. Silver's Monday open is going to be determined by which version turns out to be true. And the gap between those two versions is the widest diplomatic uncertainty gap I have tracked since the war began on February 28th. Now, let me layer on the Trump deadline because this creates an explicit time pressure that makes Sunday night silver dangerous regardless of your directional view. Trump gave Iran a 3 to 5 day window from April 22nd to engage meaningfully in negotiations. 3 days from April 22nd is Sunday, April 27th. 5 days is Tuesday, April 29th. The deadline either expires tonight or it expires Monday. Trump has already ordered the U.S. Navy to shoot and kill any vessel caught laying new mines in the Strait. He has seized Iranian oil tankers in the Indian Ocean this week. Iran seized 2 large cargo ships in the Strait on Wednesday. 30-plus vessels have been attacked since February 28th, during what is officially a ceasefire. When Trump sets a 3 to 5 day deadline and the deadline expires with no deal, the historical pattern from this conflict is immediate escalation, not rhetoric, actual kinetic action. The last time talks collapsed, Brent crude spiked 7% in under 2 hours, and silver flash crashed 5.11% to $75.65 overnight. That happened Wednesday night into Thursday morning of this week. Monday morning could be a replay at even greater magnitude because the stakes are higher now and patience on both sides is measurably thinner. Here's the asymmetric price setup that makes Monday uniquely dangerous. Silver closed at $75.59 Friday. The week's range was $80.13 on Monday to below $75 on Friday before recovering. If Islamabad produces a deal framework this weekend, oil drops from $105 toward $88 to $90. Dollar weakens, and silver gaps up $4 to $8 at Sunday night's open. That puts silver between $79.59 and $83.59 before U.S. traders even open their laptops Monday morning. Every person who panicked, sold this week at $76, $77, $78, chases the move higher and amplifies it. Short covering from the institutional players who pushed silver down all week accelerates the gap. The weekly loss gets fully erased in one overnight session. If Islamabad fails and the deadline passes without progress, Trump issues the green light to Israel. Israel's defense minister confirmed Thursday that Israel is prepared to resume war with Iran and is awaiting exactly that green light. Israeli strikes on Iranian infrastructure restart the kinetic conflict. Oil spikes above $110. Silver initially flash crashes on COMEX paper as the hawkish Fed narrative intensifies, potentially testing $72 or the critical $70 triple-tested floor. The move in either direction happens in the overnight session between Sunday 6 p.m. and Monday 8 a.m. Eastern. This is not a market you want to be flat or confused in when the open hits. Now, let me give you the data that exists independently of whatever happens in Islamabad, because there are 4 simultaneous pressure events loading for Monday that have nothing to do with diplomacy. The first is the COMEX May delivery countdown. Today is Saturday, April 25th. May 1st notice day is approximately 4 business days away. Monday, April 28th, is the last practical day for any contract holder to roll their May position to July without taking delivery risk. The arithmetic has not changed. 241.8 million ounces of May paper open interest against 76.9 million ounces of registered physical silver. Coverage ratio, 13.2%. Paper to physical leverage, 7.5 to 1. Every institutional player holding a May contract that has not rolled is making a binary decision this weekend. Roll to July and walk away, or stand for delivery and receive 1,000-ounce bars from the registered vault at whatever Monday's opening price is. The financial incentive to stand for delivery is currently the highest it has been at any COMEX delivery window in recent years. COMEX paper at $75.59. Shanghai physical at approximately $90. The spread is $14.41 per ounce. After shipping costs of $2 to $3 per ounce, the arbitrage profit from taking COMEX delivery and selling physical in Shanghai is $11 to $12 per ounce. On a 5,000-ounce contract, that is $55,000 to $60,000 of profit per contract. For an institution holding $200 May contracts, that is $11 to $12 million of arbitrage profit available through the delivery mechanism. At those profit levels, the rational decision for any institution with physical delivery infrastructure is to stand for delivery rather than roll. And Monday morning is when those decisions get executed. The January 2026 precedent makes this urgency concrete. During January's delivery window, 33.45 million ounces were withdrawn from COMEX registered vaults in a single week. That was 26% of the entire registered inventory drained in 7 trading days. The registered vault had approximately 88 million ounces before that withdrawal. Today, it has 76.9 million ounces. The drain that happened in January has not been replenished. Each delivery cycle depletes the registered inventory further. If May produces even half of January's delivery intensity, the vault drops from 76.9 million ounces to approximately 60 million ounces. Coverage ratio falls from 13.2% to single digits on outstanding paper claims. At that point, the next QOT report becomes the mainstream financial media's lead silver story for the first time since the ATH. And retail attention plus institutional delivery pressure plus negative real rates equals a price move that makes 75.59 look prehistoric. The second pressure event loading for Monday is Kevin Warsh. The DOJ dropped its probe of Jerome Powell Friday afternoon after markets closed. Senator Tillis removed his confirmation block. Warsh's Senate confirmation vote is now expected this week or next. Powell's term expires May 15th, which is 20 days from today. Here's the specific mechanism by which Warsh's confirmation creates Monday volatility. Warsh's nomination on January 30th crashed silver 27% in one session. That was on a nomination, not a confirmation. A confirmation is permanent. It is not a headline that gets reversed. When Warsh is confirmed, likely this coming week, his stated agenda immediately begins shaping market expectations. Fewer FOMC meetings, no press conferences after rate decisions, a new monetary framework whose specifics he refused to reveal during Tuesday's hearing. Less transparency from the Fed means wider uncertainty bands around rate decisions. Wider uncertainty means higher volatility in rate-sensitive assets. Silver is one of the most rate-sensitive commodities on Earth because its paper price is directly suppressed by positive real interest rates and liberated by negative ones. But here is the Warsh paradox that makes Monday's reaction unpredictable. Warsh is a hawkish inflation fighter who wants stronger dollar policy. That is short-term bearish for COMEX paper silver. But Warsh's hawkishness applied in a stagflation environment where CPI is 3.3% and GDP was 0.5% in Q4, 2025 is a policy framework that cannot actually work. You cannot fight 3.3% inflation that is driven by a supply shock from a blocked oil strait by raising interest rates. Higher rates slow demand. They do not reopen the Strait of Hormuz. They do not rebuild Iranian nuclear facilities. They do not reduce oil supply destruction. Warsh will be confirmed into a policy environment where his tools cannot address the actual cause of inflation. The market will eventually understand that contradiction. When it does, silver's structural bull case overwhelms the short-term hawkish narrative. Monday's initial Warsh reaction might be negative for paper silver. The medium-term Warsh reality is strongly positive for physical silver. The third pressure event is the University of Michigan data that market participants are only beginning to digest this weekend. Consumer sentiment at 49.8 is an all-time record low, but the more important number for silver on Monday is the one-year inflation expectation of 4.7%. That jumped from 3.8% in March, a 0.9 percentage point increase in 1 month, the largest single-month jump since April 2025's tariff shock. Here is the specific Monday mechanism. The Federal Reserve enters its pre-meeting blackout period this weekend. The FOMC meeting is Wednesday, April 29th and Thursday, April 30th. No Fed speakers will provide any guidance or calming commentary from now until after May 7th, when the blackout ends. That means the 4.7% inflation expectation number sits in the market without any Fed official being able to contextualize or moderate it. Institutional investors and algorithmic traders will be pricing 4.7% expected inflation against the 3.5% Fed funds rate over the weekend and Monday morning. The real rate calculation is 3.5% minus 4.7%, which equals negative 1.2%. Negative real rates of 1.2% with no Fed speakers available to push back means the monetary case for physical silver goes uncontested in Monday's market discourse. The fourth pressure event is an event that most people in the silver community did not notice this week, but that has direct implications for physical metal demand on Monday. The U.S. Treasury froze $344 million in Iran-linked cryptocurrency this week. Treasury Secretary Bessent confirmed the seizure. When a government demonstrates that it can identify, track, and freeze cryptocurrency holdings linked to a specific adversary nation, it sends a message to every asset holder who uses digital stores of value as a safe haven. The message is that digital assets have a counterparty risk that physical precious metals do not. A wallet balance can be frozen by executive order. A crypto exchange can be compelled to comply with government seizure. Digital assets leave trackable signatures that make them vulnerable to exactly the kind of targeted financial warfare the U.S. just executed against Iran. Physical silver in your possession has no such vulnerability. You cannot freeze physical silver remotely. You cannot confiscate it with a Treasury designation. You cannot delete it with a server shutdown. The $344 million Iran crypto seizure will drive a measurable number of investors toward physical precious metals in the week following its announcement. That demand flow starts Monday. Now let me give you the macro data picture for next week, because the week of April the 27th through May 2nd is simultaneously the most important data week and the most important delivery week in modern silver market history. On Wednesday, April 29th at 2 p.m. Eastern, the Federal Reserve announces its April rate decision. The probability of a rate hold is 99.5% according to CME FedWatch, but the rate itself is not what moves silver on Wednesday. Powell's press conference language moves silver, and this is Powell's last press conference ever as Federal Reserve Chairman. His term expires May 15th. He will not hold another press conference after this one. Powell knows this. The market knows this. And a Fed chair giving his final press conference in a stagflation environment with 4.7% consumer inflation expectations, $105 oil, and a COMEX delivery crisis building has every incentive to say something historically significant. If Powell signals that rate cuts remain possible in 2026 despite the inflation pressure, silver gaps up $3 to $5 immediately as the real rate calculus improves. If Powell says inflation is the primary concern and cuts are off the table, silver faces another leg down. On Thursday, April 30th, the advance estimate for Q1 2026 GDP releases. The IMF's current forecast for U.S. GDP growth is 1.8%, but the composition of Q4 2025's 0.5% GDP print, which triggered the stagflation designation, suggests Q1 could disappoint significantly. If Q1 GDP comes in negative, the United States technically enters recession in the same quarter that inflation expectations are at 4.7%. Recession plus accelerating inflation expectations is the purest stagflation signal available. It is also the signal that historically produces the most explosive precious metals moves because it forces the Fed to choose between fighting inflation and fighting recession. And that impossible choice destroys confidence in paper currency. Core PCE for March also releases Thursday. Given that CPI already printed 3.3% and gasoline spiked 21.2% in March, core PCE is likely to confirm the inflation pressure. If core PCE comes in above 3%, the 2026 rate cut thesis dies completely and the stagflation trade becomes the dominant market theme. On Friday, May the 2nd, non-farm payrolls released for April. This is also the day that COMEX May 1st notice day officially lands, both events on the same day. If payrolls disappoint, recession fears. Combined with delivery pressure for a volatile Friday, if payrolls beat, the dollar strengthens temporarily, but the underlying delivery mechanics force the physical premium wider, regardless of the paper price reaction. Here's the additional geopolitical layer that makes next week uniquely dangerous for a silver investor who is not paying attention. Italy announced this week that it is sending 4 naval vessels to the Strait of Hormuz region. This is a NATO member deploying warships to an active conflict zone where the United States and Iran are simultaneously enforcing competing blockades. Italy's naval deployment signals that European nations are moving beyond diplomatic support for U.S. Hormuz operations into active military positioning. when NATO members begin deploying naval assets to the same waterway where Iran is seizing cargo ships and the U.S. is seizing Iranian oil tankers, the conflict expands beyond a bilateral U.S.-Iran confrontation. It becomes a multilateral standoff with more parties to coordinate, more potential for misidentification incidents, and more pathways to accidental escalation. More parties in the Strait means more uncertainty. More uncertainty means higher oil price risk. Higher oil price risk means deeper and more permanent silver supply cost inflation. Let me now connect this weekend's developments to the data point that never changes, regardless of any diplomatic outcome. The Silver Institute's World Silver Survey 2026 confirmed 6 consecutive annual supply deficits. Cumulative deficit from 2021 through 2025 is 762 million ounces. The 2026 projection is 46.3 million ounces of additional deficit, 15% larger than 2025. COMEX registered inventory has declined 64.1% from 240 million ounces in April 2020 to 76.9 million ounces today. China is importing silver at an 8-year high pace of 206.76 tons in just January and February 2026. China restricts exports to 44 authorized companies. China's sulfuric acid ban threatens 70% of global silver byproduct supply, with Chile already seeing 44% price spikes in sulfuric acid from the Chinese supply disruption. Mexico supplies 25% of global silver with a Section 301 tariff investigation hearing scheduled May 5th, which is 10 days away. None of those numbers change based on what Araghchi and Witkoff say to each other in Islamabad this weekend. The 762 million ounce structural drain is permanent. The 6th consecutive deficit continues accruing. The China export restriction stays in place. The Chile acid price spike reflects a supply chain disruption that takes months to reverse. The Mexico tariff hearing proceeds regardless of ceasefire status. These are the bedrock fundamentals that make 75.59 on Saturday, April 25th, 2026, the wrong price for silver, regardless of what Monday's open looks like. Here is your complete Monday setup in the clearest terms possible. If Islamabad produces a deal framework this weekend and Trump's deadline is met with substantive progress, Sunday night's silver open gaps to $79 to $84. Short covering amplifies the move. The week's losses get erased. Physical buyers who loaded up at $75 to $76 this week see immediate vindication. If Islamabad fails, Trump's deadline expires without progress, and the green light to Israel is given, Sunday night silver tests $72 to $73. The $70 triple-tested floor comes into view. Physical buyers step in aggressively at those levels as the COMEX arbitrage versus Shanghai's $90 physical becomes too profitable to ignore. In either scenario, the 4 background pressure events, the COMEX delivery countdown, the Warsh confirmation, the 4.7% Michigan inflation expectations, and the Iran crypto seizure demonstrating physical metals counterparty-free advantage are all simultaneously loading pressure into Monday's market. The brutal move on Monday morning is not the surprise. The surprise is which direction. And if you do not have your plan mapped out before Sunday night's 6 p.m. open, you are reacting instead of positioning. The setup is built. The data is clear. Monday arrives in less than 48 hours.